Hey, good morning, everyone. Thanks for the introduction, Alan.
Yeah, great. Thank you. So, I remember you mentioning that you taught a class similar to this back in your days at Stanford. A little bit about that?
Yeah. So, as Ellen mentioned, I've been out here in Silicon Valley for most of my career working on Bitcoin. Back in 2015, I helped teach the first Bitcoin class at Stanford when I was in graduate school there in the computer science department. It was back in the days where Bitcoin wasn't super popular, but it was just sort of getting paid attention to in academia. And since then, that class has gotten very, very popular, as you can imagine. And the industry has come a very long way.
So did you start were you the first one to start teaching that class, or was it like the first time the class was being offered?
So it was the first time the class was being offered on campus. The main professor, Dr. Dan Benet, had decided he wanted to start teaching this. He's the cryptography professor at Stanford, and I was I had just started at Stanford, and because I had worked in the industry before that, I was one of the few students on campus. I was actually able to help him with this class, and so I was a perfect fit.
Great, awesome. Okay, so before you start your presentation, I remember that we were going to run a poll just to get a sense of the room. So for the audience, I'm going to start a poll, and we'll give you about 10 seconds. It's really easy questions for us to understand you a little bit better. So let's launch it, and then Alex can go into his presentation.
Sure.
Okay, you can see the results, right, on your side, Alex?
Let's see.
Oh, cool. Okay. If not, I will share the results when everyone has voted.
I'm not sure I can see them. Yeah.
Okay. Finishing. Let's see. So right now, the majority of the people in the room, 74% of you say that you're beginners in terms of your knowledge in Bitcoin. Around 22% intermediate knowledge, and then we have one person who says he's an expert. So, I would love to know who you are. Reach out to me. Yeah. And in terms of investing in Bitcoin, we have, well, the majority, they don't invest in Bitcoin right now. So that's 79% who don't invest. And we have about 20% of people, 6 people here who invest in Bitcoin. Okay.
Great.
Oh, great.
Well, it sounds like a lot of people will get something out of this presentation. Hopefully maybe something for the expert in the room, but we'll see. Maybe he'll teach us something.
Awesome. Okay,
great.
So I'm going to end the poll and then let you take over, Alex.
Excellent. Awesome. Well, I'm going to get started here. It's great that a lot of people are pretty new to Bitcoin, so I'm going to try to keep this pretty high level and digestible. Bitcoin can be quite intimidating and difficult to understand. It's a concept that doesn't fit into any box that before Bitcoin existed we were used to having. Is it money? Is it an investment? Is it like stocks? What is this thing? And hopefully by the end of the presentation today, you'll have a little bit of a better grasp of how to reason about Bitcoin, how it manifests itself. What is Bitcoin physically or digitally? How do you use Bitcoin? And these are the things that I'm going to go over. I'm also going to discuss how did Bitcoin get started? Where did it come from? And why are people buying Bitcoin today? Why is the price of Bitcoin going up so quickly? What's going on? Before I jump into those things, I'll give you a little bit of overview of just myself. So you heard most of my background. I've been a software engineer in the Bitcoin space for most of my career. That started River Financial or river.com. Feel free to go to our website now if you'd like. You can see what it looks like. We also have a mobile app. And what we do at River Financial is we make it very easy for people to buy, sell, and use Bitcoin. Most of our clients come to us. They've never had Bitcoin before. They don't know how to think about it. They're kind of interested in getting their feet wet with it. And we make it very, very easy for them to buy their first Bitcoin and get started and hold their hand through that process. It takes about 2 minutes to sign up and buy Bitcoin on our platform. And we also have a lot of good educational materials at river.com/learn if you're interested in digging more into the details of some of the stuff we talk about today. So as the CEO of the company, I see a lot of the behind the scenes of the Bitcoin markets. I see a lot of the behind the scenes of how who's buying Bitcoin and why and how much. And it's a pretty interesting job. And I hope to share some of those insights with you today. So before jumping into exactly how Bitcoin works and exactly where it came from, I think it's important to start with a higher level question about what is money? Because it's that question that actually led to Bitcoin's creation. It's that question that led to a person named, or a group of people we don't really know, named Satoshi Nakamoto, an anonymous individual or group, to create Bitcoin. Their goal was to create a better money, a better place where you can store and transact wealth. And so, going back in history, very quickly, not an in-depth history lesson here, but before humans had money, we had barter. We were able to directly transact goods and services with one another. There was no intermediate currency that was universally accepted that we could all use. For example, if I had some apples and Ellen had a chicken, and I wanted the chicken and Ellen wanted apples, we could swap. Now, most of you are probably thinking, well, how does that really work? How does that scale? The answer is it doesn't. This actually doesn't work well at all. It requires what's called a coincidence of interest. It's very rare that actually the stuff you have is the stuff that other people want, and what they have is what you want. So very early on in our human civilization, humans came up with this idea of money, with this idea of having some resource, some asset that can be used to transact and store value. Different things have been used as money all over the world. In the early days, in North America, for example, seashells were used as money. In the Western world and in Asia, gold started being used as money very early on. Precious metals were used as money very early on in our civilization. When you look at what kinds of things people chose to use as money, they all had a few very important qualities. The most important of which was scarcity. No matter what humans have used as money throughout all of history, the biggest, most important aspect of that money was scarcity. When it comes to seashells, they used seashells that were scarce. You couldn't just make more of them. With gold, it's the same thing. Finding more gold requires going and mining it. It's a very resource-intensive process, and there isn't that much gold in the world. There's a reason that nobody used wood as money, or diamonds as money. One of the interesting aspects to good money is that it's actually pretty fungible. One piece of money is as good as the other. Over time, humans started evolving in our understanding of money, what could be used as money. Eventually, we started thinking, well, why do we even need to transact gold directly? Why can't we have gold in a vault and have some paper notes represent that gold and pass that around? So over time, as you know, sort of money evolved. Eventually, we let governments control what we use as money. And eventually, the money that we used didn't have any backing at all by any sort of natural scarcity. In fact, it just became a scarce piece of paper that the government enforced. The only reason that the U.S. dollar is good money is because the government makes it very difficult for other people to print money or counterfeit it. There's no natural scarcity to the US dollar. It's a centrally enforced scarcity. Now, as you may have noticed at the grocery store or at anywhere else you spend money, prices are going up pretty quickly. The scarcity of the US dollar isn't what it used to be. The government over the last year has printed a lot of money, and that sort of made a lot of people think, what's going on here? If a scarcity is centrally enforced, what's to stop that central party from slipping and making more of this and making the money less valuable for everybody? So that's where Bitcoin comes along. Bitcoin was created to be a scarce asset for the digital world. It's the first digitally scarce asset that isn't controlled by a central party. Previously, we had digital dollars. We have digital dollars today. All of our balances at banks are stored on some computer. But all of those balances are protected by a central party, either a bank or another financial institution. Bitcoin, on the other hand, is this digitally scarce asset, kind of like a digital gold. It's not controlled by any party. It's completely decentralized. There will only ever be 21 million Bitcoin. Now, that might raise a lot of questions for you. How can that be possible? How does that even work? What does that even, that doesn't make any sense. And through this presentation, I'll walk you through how this system actually works and why it's actually pretty valuable for society. But the big thing to remember is the easiest way to think about Bitcoin today is like a digital gold. It's like a digital scarce asset that you can collect, store value in, and move around. So, as I mentioned, Bitcoin is a decentralized monetary innovation. It's a completely decentralized network. It is used today by people for a number of reasons, the biggest of which is to store and protect value. Most people today are buying Bitcoin as a long-term way to protect their wealth, because the amount of Bitcoin that will ever be created is 21 million. There will never be more than 21 million Bitcoin. That scarcity is enforced by the rules of the Bitcoin network. There's no central institution. There is no person that can change those rules. And this scarcity is enforced by algorithms in a decentralized system. Now, you might be thinking, well, if there's only ever going to be 21 million, how could the whole world use Bitcoin if there's not enough for everybody in the world to have one Bitcoin? Well, each Bitcoin is actually divisible into effectively infinite pieces, just like gold. You can have a bar of gold, or you can have a little flake of gold. Just like with Bitcoin, you can have a whole Bitcoin, or you can have a tiny fraction of a Bitcoin. There's nothing stopping you from splitting it up, breaking it up, and moving it around in little amounts. So let's go back to where Bitcoin came from, right? I talked about the history of money, and this history of money was well understood by the creator of Bitcoin, Satoshi Nakamoto. And Satoshi also understood the risk and the dangers of using money controlled by central authorities that over time inevitably get a little too tempted to print too much of that money. If you have control over the money supply and you have control over the ability to print money, you inevitably start to do it a little bit too much. This is a story that's played out time and time again throughout history. And Satoshi also knew that we were moving to a digital world, a digital era. And we needed some digital money that was not controlled by any third party. So in 2009, he released the project he'd been working on, the Bitcoin code base. Now, a lot of you might be thinking, well, this one person created Bitcoin, so isn't it centrally controlled? Why should I trust this thing? Who is this guy? We don't even know who he is. Why should we trust this? Well, Bitcoin is actually open source. The Bitcoin network is made up of thousands and thousands of computers running the Bitcoin code base. A computer running the Bitcoin code base is called a Bitcoin node. And Bitcoin nodes all talk to one another. Bitcoin nodes look at Bitcoin transactions in the network, verify them, and send them around to all of their peers, the other computers that are talking to them. These Bitcoin nodes also keep the central records of the Bitcoin network. It's the ledger of the Bitcoin network called the blockchain. And we'll talk about what a blockchain is in a second. But going back though, these Bitcoin nodes and the software that these Bitcoin nodes run is completely open source. What that means is that anybody in the world can look at the code that they're running and see exactly how it works. There is no secret in Bitcoin. There's nothing that any creator of Bitcoin could hide in there. Everyone participating in the Bitcoin network can see exactly what the rules of the Bitcoin network are and what the software is that they're running. So going back to this blockchain thing, So I have a little diagram here in this slide. It shows two blocks connected by these things called hashes. Now, we're not going to go deep into math or cryptography here, but at a high level, the thing to understand is that at its core, Bitcoin is a ledger. And that ledger is referred to, the technical term for this ledger in the Bitcoin network is the blockchain. You've probably heard that word before a lot of times. A blockchain is just a ledger. A blockchain is just a list of transactions that have happened in the Bitcoin network. And if you have this list of transactions or this ledger, you can easily calculate and see which parties or entities have how much Bitcoin. And whenever a new transaction is sent from one Bitcoin holder to another, Bitcoin nodes receive this transaction and can see, is this transaction valid? Did the person who sent this Bitcoin have the authority to send it? Did they provide the proof that they have the right to send those funds? And if they did, then I can consider this transaction valid. Another rule to check would be, is this person creating Bitcoin out of thin air, or are they sending Bitcoin that they have less Bitcoin or as much Bitcoin as they actually have, right? There's all these rules that get checked. And this is how the ledger gets updated. Now, the way this works is through the way these updates to the ledger work are through blocks. Every block is a new set of transactions that get updated on the ledger. And these blocks are batches of transactions. A new batch of transactions is added to the Bitcoin blockchain. So a new block is added to the Bitcoin blockchain about once every 10 minutes. And these new blocks get added through another party in the Bitcoin network called miners. You might have heard of mining. This is just another diagram of a blockchain. And whenever a new block is added, it points back to the block before it. And that's relevant because what this means is that the blocks need to be added sequentially. You can't just go back and insert a block in, kind of 10 blocks or 100 blocks back into the ledger. It's an append only ledger. You can only keep adding blocks to the front. So I mentioned these blocks get added through a process called mining. What is that? What is mining? You've probably heard this. You're like, how does mining work with computers? I thought mining was digging into the ground. Okay, so as I mentioned, there will only ever be 21 million Bitcoin. But there actually aren't 21 million Bitcoin today. There are about 18.5 million Bitcoin. So so new Bitcoin have to be created somehow. New Bitcoin is created through a process called mining. Whenever one of these new blocks gets added to the blockchain, it's added by somebody called a miner. What the miners do is they run Bitcoin nodes and they see all of the new transactions in the Bitcoin network. All of the transactions that somebody wants to send and have included as part of the ledger, they see all of these. They collect all these transactions up and put them into a block. A block is just a chunk of transactions. And then they run an algorithm. They run a complex mathematical computation on this chunk of transactions. And they run this computation over and over and over and over again with special computers. And if they're lucky, one of the times that they run this computation, they'll get a result that gives them the right to add this block to the blockchain. So the more mining power a miner has, so the more computational power a miner has, the more likely they are to be the one who gets lucky enough to add this block to the ledger. So why do we need this? Why is this the way that transactions get added to the blockchain? Well, we need some way to determine who's allowed to update this ledger. Since we don't want to trust a central party, we need some decentralized mechanism to figure out who gets the right to add to the ledger, to add a block to the blockchain. And by requiring a lot of computational effort to get the right to do this, we make it very, very expensive to go back and rewrite the history of the Bitcoin blockchain. Because to rewrite the history of the Bitcoin blockchain would require you to have a significant more amount of computational power than all of the computational power that went into getting it to where we are today. And that's infeasible for pretty much anybody. This keeps the ledger secure. It prevents somebody from convincing another person of a fake version of the ledger. And so why would these miners actually go through all this effort? Why would they go through all this hassle? Well, the answer is because if you're selected to mine a block, you get to award yourself a small amount of new Bitcoin. This is called the block reward. This is how new Bitcoin are created, and this is what incentivizes this mining process. So that might sound a little bit confusing. You know, it takes some time to really wrap your head around why this is secure, why does this work at all? But high level, the way to think about this is the Bitcoin ledger is secured by all of this computational power. The people who are performing this computational power get rewarded by newly created Bitcoin. And over time, this reward will go down and down and down until only 21 million Bitcoin have been created. At that point, miners will be rewarded with transaction fees instead of this block reward, new Bitcoin. Instead, they'll be rewarded with fees that everyone who sends transactions in the Bitcoin network have to pay. The picture on this slide here is a photo of a very large mining farm. It's basically, mining farms are basically big warehouses full of specialized computers called ASICs, A-S-I-C. That stands for Application Specific Integrated Circuit. That's not very important, but what's important to know is these computers are built specifically for mining Bitcoin. If you tried to mine Bitcoin on your laptop today, or even on a GPU or video card, you wouldn't. It would be a total waste of electricity. Yeah, you wouldn't be able to mine any significant amount of Bitcoin. In the early days of the Bitcoin network, you could mine on a laptop, but mining has gotten so competitive, you need these specialized machines to mine it all. So we talked about where Bitcoin come from. Bitcoin are mined. So how do you transfer Bitcoin? Okay, so if I'm a miner and I've mined some Bitcoin, how do I send it somewhere to sell it to help cover my energy costs, right? So when you own Bitcoin, this Bitcoin can live in a number of different places and in a number of different types of wallets or accounts. Initially, everybody stored their own Bitcoin on their own computers. They had special pieces of software on their computers that helped them keep their Bitcoin secure. Now, what does it mean to own your Bitcoin or keep it on your computer? Well, all that really means is actually keeping these things called secret keys. They're just like these big secret numbers. These numbers allow you to sign Bitcoin transactions to spend your Bitcoin. Basically, the way to think about it is kind of the password to your Bitcoin account is your Bitcoin. You can think about it like if somebody has the password to your bank account, they can get access to your money. Well, with Bitcoin, your password is your money. And these secret keys are that password. And so when people talk about storing their own Bitcoin, they're really keeping these secret numbers on their computer, and they have special pieces of software that do that. Now, over time, services came along to make it more convenient for people to secure their Bitcoin, like a bank. Companies like ours at River.com, we're like a Bitcoin, quote unquote bank. We help you. We help take care of that security for you, right? We make it very easy to store Bitcoin because we actually take care of securing those secret keys, instead of you having to do it. Instead, all you do is log into your account with River and tell us where you want to send the Bitcoin. So we're what's called a hosted wallet. We are a third-party service that you trust to secure your Bitcoin for you. Unhosted, self-hosted wallets are wallets that you control yourself. It's kind of like keeping your cash in a bank versus keeping your cash in a vault in your house. There's pros and cons to each. This is a screenshot here of what it looks like this. This is a screenshot here of what it looks like to send Bitcoin from your River.com wallet. You enter the destination address you want to send it to. It's a long string of letters and numbers, the amount, and we show you a fee that you'll be paying. And that fee is usually pretty small. It's a fee that goes to the Bitcoin miners who are mining your transaction. Okay, we talked about mining, but mining isn't something most people are ever going to be doing. So at the end of the day, how do most people get Bitcoin? Sorry, I see a question here. What prevents governments from using their supercomputers to mine Bitcoins? Well, that's a great question. So going back to mining here, supercomputers are actually pretty bad for mining. Supercomputers that the NSA has, that these other governments and research labs have, are actually built to run arbitrary types of computations. And they're very fast for running simulations, for running things like that. But the chips that they have inside are built for general purpose computing, for taking a program, and they don't know what the program is going to be and running that. They need to be flexible enough to serve a number of different research purposes. With Bitcoin, the actual physical computer chips of these miners are built specifically only for this one task. So they're even much faster for doing this one thing than a supercomputer would do. These computers actually, they're completely useless for anything else. You literally cannot run anything else on them other than running this one Bitcoin algorithm. And so government supercomputers wouldn't be helpful there. They would have to buy a bunch of these specialized Bitcoin miners to mine. But that said, governments could do that. There's nothing stopping them. So going into, how do you get Bitcoins? So there's three ways to actually get Bitcoin. You can buy it, which is what the vast majority of people do. And that's what we do at our company. We make it very easy for you to connect your bank account, enter an amount of Bitcoin you want to buy, whether it's $100 or $100 million worth, and buy Bitcoin. And we keep that secure for you until you ever want to move it somewhere. And that's what most people choose to do. But a second option is to earn it. Some people actually earn Bitcoin. They perform jobs or services online, and they get paid in Bitcoin. And that's an increasing and growing amount of people. A lot of people want to start getting paid in Bitcoin. And the last thing is to mine it, which we just talked about. When you buy Bitcoin, it's just like buying a stock or something like that in terms of how you actually do it online. It's very simple. So let's jump into, okay, so why are people buying Bitcoin? Why is anyone doing this at all? So we see a lot of people buying Bitcoin at River.com for a number of different reasons. But the most popular reason that we see is people worried about inflation. People over the last few years have been increasingly worried about the long-term, people have seen the prices going up. They've seen government printing money, and they've decided, they want to put their assets into something that is scarce, that something that the government can't print more of. And Bitcoin is one of the few things like that. Historically, people would have looked to gold to help preserve their wealth. But as the world becomes more and more digital and more connected and computerized, people are looking towards the future. And a lot of people see Bitcoin as the digital gold, the gold for the digital era. So that's why most people are buying Bitcoin from us. Now, there are people who buy it just to speculate and gamble on the price. that's certainly something that happens. But for our customers, most of them are buying to hold for the long term. And then a secondary use case today is people buying it because they need to send money somewhere. Sometimes they need to send money to another country, or they just want to have Bitcoin that they store in their own computer in case they ever need to move their money somewhere. And this is going to be, I think, a use case that grows over time. Most people still rely on traditional payment rails to send money because Bitcoin is still in the phase where it's a store of value. It's a long-term investment for most people. It hasn't yet entered the phase of becoming a medium of exchange or unit of account widespread. It's still a little too volatile, and the infrastructure hasn't been built out for it to be used as the base currency for an economy. But I think that might be a possibility someday. And since its inception, the Bitcoin price has increased drastically. It's gone from 10 cents in 2010 to $57,000, $58,000 where we are today. So going back to the economics of Bitcoin, this chart shows the amount of Bitcoin that will exist over time, the Bitcoin supply over time. This is one of the most attractive things about Bitcoin. There's pretty much nothing else before Bitcoin. There's no other resource or asset where we know exactly how much will exist at any point in time in the future. This gives people a lot of predictability and certainty. And when it comes to a place to park wealth, that's what people are looking for. So how does Bitcoin stand in comparison to other assets today? Well, if we look at all the Bitcoin, the value of all the Bitcoin in the world, in total, that's about $1 trillion worth of Bitcoin that exists. Now, what if we compare that to gold? Well, the amount of gold that exists in the world is worth about $10 trillion. So if Bitcoin were to be worth, were to actually surpass the value of gold in aggregate, or to beat gold, for lack of a better term, the Bitcoin price would end up being around $535,000 a Bitcoin. Now, I'm not saying that's going to happen, but that is certainly sort of a benchmark to potentially look at when considering, why you might want to own Bitcoin. Another interesting aspect of Bitcoin is this fact that the amount of Bitcoin created in every block gets cut in half every 4 years. So the rate of new supply of Bitcoin gets cut in half every 4 years. And this chart here demonstrates the either coincidental or not coincidental timing of these halvings. So basically what this chart shows is the gold bars. Okay, so the gold bars, the left side of the gold bar is when a Bitcoin halving event took place. And the right side of the gold bar is the price peak during that era. And so historically, what we've seen is every time the Bitcoin supply gets cut in half, or the amount of new supply gets cut in half, the Bitcoin price tends to rise afterwards. Now, again, past performance does not guarantee future performance, but it is an interesting trend to notice. So I want to leave the time for questions, so I'm going to kind of move quickly here. But what is the future of Bitcoin, right? I think we're entering an era where Bitcoin will be seen as like the perfect asset for collateral. If you want to borrow dollars and you have Bitcoin, putting that Bitcoin up as collateral to borrow that cash is going to be very easy to do. Selling your Bitcoin is a taxable event. I think a lot of people aren't going to want to do that. I think a lot of people will over time save in Bitcoin and borrow cash against their Bitcoin. Additionally, we're seeing this second layer evolve on top of Bitcoin. This ability to use the Bitcoin blockchain as a settlement layer and move Bitcoin around very, very quickly on second layers on top of that, either fully decentralized second layers like the Lightning Network, or centralized second layers like River or Cash App, being able to just transfer Bitcoin to other people within the same financial institution. And then over time, we might actually see a machine-to-machine economy emerge. Bitcoin is the first asset that you actually don't need to be a human to own, or a company, or a legal entity, or a legal person. A computer program can own Bitcoin and transact with other computer programs. What will that future look like when computer programs start becoming economic actors? I think it's kind of an interesting question. So little quick summary about who we are at River. We were founded in February of 2019. As I mentioned, we make Bitcoin very easy for people. And we're a venture-backed company. We're backed by a lot of great investors. And we have a number of services for all tiers of clients, whether you're a kind of normal user or you're an ultra high net worth individual looking for a white glove service. We can support your needs. We obsess about our customer service and security. Those are our two primary obsessions. We also have a lot of great resources if you're interested in learning more about Bitcoin. We have a River Learn section and a River Intelligence about market updates and more timely events in the Bitcoin space. Let's open it for questions. I have a QR code here and a link. If you'd like to get 0 fees, you can use this link, and I'm happy to jump into any and all questions people have.
Great, awesome. Thank you so much, Alex. I learned so much this morning about Bitcoin. We have a lot of great questions that came in through the Q&A function, so we'll get to those right now. Can you actually see it on your end, Alex? Or
yeah, I have them here.
Okay, cool. So the first question, for those who are unable to see it, is from John, and he's asking, what are your thoughts on the environmental impacts on mining Bitcoin?
Yeah, so that's a great question, and that's been a big topic of discussion in recent weeks. So as I mentioned, the Bitcoin mining process takes a lot of energy, but so does everything else that's useful in the world, right? And gold mining takes a lot of energy. Central banking and the enforcement branch, the US military and Secret Service that keeps the US dollar secure, takes a lot of energy. Inevitably, any good money that has ever existed in the history of the world is an energy intensive endeavor. So I think the real question is, how can we move to a world where the energy kind of cost of the environmental impact of Bitcoin mining is minimized? And that means moving towards a world where the net sort of carbon and other environmental sort of aspects of the Bitcoin mining process are as minimal as possible. And the good news is that most new Bitcoin mining being started is very economically and environmentally friendly. So there's a lot of with renewable energy. There's a lot of latent renewable energy because of our inability to store that energy when it's created. And so there's a lot of excess renewable energy at different times of the day that is increasingly being used to mine Bitcoin. Additionally, things like natural gas flaring is increasingly being used to power Bitcoin mining. Right now, a lot of latent natural gas is just being flared off in places like Texas and Oklahoma. Instead, they're starting to use that to mine Bitcoin instead of just burning it purely into the atmosphere. So the trends are good. I think we're moving to the right direction, but it's an important conversation to have.
Awesome. I just left a link to one of the articles that you guys wrote about environmental impacts from Bitcoin in the chat. So,
great.
Check it out, everyone. Second question from John is about taxes. So he's asking, what are the implications with the new tax bills that the government wants to implement? Even today, any taxable event must be claimed in our tax returns according to the IRS. Is there a tax shelter for Roth, IRA, 401k, life insurance, Bitcoin?
Yeah, that's a great question. So, let's start with how Bitcoin is taxed today. So Bitcoin is taxed just like other property is taxed today, like stocks and other investments. If you buy a Bitcoin today and the Bitcoin price doubles and you sell your Bitcoin, you'll owe tax on that difference. And that tax will depend on both your total income for the year, if it was a short-term capital gain, and if it was a if you held that Bitcoin for more than a year, it'll be taxed as long-term capital gains. Now, this question is going into, well, what if the government also taxes long-term capital gains like short-term capital gains, or increases capital gains taxes in general? This is going to be even worse, right? And so, how do you protect yourself from those taxes? Well, there's a number of ways. And by the way, I just want to qualify this: I'm not licensed to give tax or investment advice, but I can tell you what I see people do. And so what I see people do is buying Bitcoin into IRAs. That is certainly, or 401ks. People do that. There are a number of ways to do that, and that can mean buying the GBTC product directly into your IRA. That can mean an IRA LLC that opens an account at River and buys Bitcoin. But again, you need to talk to a qualified tax professional to get answers to those questions. Now, another way to do it is to buy Bitcoin and never sell it. You might decide you never actually want to sell your Bitcoin. You just want to hold it. And if you ever want to put that Bitcoin to use, you can borrow against it. You can borrow cash collateralized by your Bitcoin. And if you think that the value of Bitcoin is going to keep going up and the value of the dollar is going to keep going down, that might be something you're interested in. And it's a way to potentially never sell your Bitcoin and create a taxable event. So now, again, you need to talk to a tax professional just to double check all of those things for your own situation, but that's sort of my answer.
Awesome, thank you. Third question, how did the number 21 million come about for Bitcoin?
So that's a constant sort of open question, but so if you look at the Bitcoin protocol, the Bitcoin unit actually isn't the core unit of the Bitcoin protocol when you dig into the software. There's actually an even smaller unit called a Satoshi. One Bitcoin is divisible right now into 100 million pieces. So if you look at the number 21 times 100 million, you get a number that sort of seems about right if Bitcoin is going to be, if this Satoshi unit is going to be sort of, there's enough of these for everyone in the world to have a good amount of them. And it's sort of a ballpark sort of number that would work if, everyone in the world were to have Bitcoin. This smallest unit of Bitcoin would be sort of like our penny. Okay,
I hope that answered the question. Next one, how does the network decide who can be a miner?
The network can't decide. Anybody can be a miner. Bitcoin is completely censorship resistant. Nobody can stop you from mining, and nobody can stop you from transacting in Bitcoin. If you decide to go be a miner, all you need to do is plug your miners in and start mining. There's no ways for someone to stop you.
Okay, so you just have to be able to afford to mine, I guess, in that way.
Exactly.
All right. So Ryan's asking, the check against alteration or hacking the blockchain is that it is computationally expensive. Instead of supercomputers, couldn't advances in quantum computing that we cannot even anticipate today make unraveling a blockchain trivially easy?
Yeah, so that's another great question. And so basically, this is getting into a fundamental property of Bitcoin, and that is, or some fundamental assumptions that the Bitcoin design makes, or the way Bitcoin is designed makes. And that is that some of these algorithms, some of these what we call cryptographic primitives that keep Bitcoin secure, the assumption is that these things can't be broken. Now, that's an assumption about our understanding of mathematics. And those are assumptions that we mathematically actually can't really prove. In fact, we know that if there were to ever be a quantum computer that was very fast, which we're probably a very long ways from ever seeing, there is a risk that some of these cryptographic primitives could be broken. Now, the reality is that is just the state of cryptography today. And that doesn't just impact Bitcoin, that also impacts all of the core computer security tooling that we use for the internet, right? So the same quantum computing breakthroughs that could impact Bitcoin would also completely break the security of the internet in general. And this is certainly something to pay attention to. It's not a risk I'm worried about anytime soon. But the reality is that our understanding of mathematics and cryptography is going to continue to evolve. And the good news is that the Bitcoin protocol has kind of smart enough developers that it can evolve with those potential threats. But it is certainly something that is not zero risk.
I hope we answered your question, Ryan. So the next question we have, what is the difference between Bitcoin and Bitcoin Cash, between Bitcoin and Ethereum? Yeah,
so Bitcoin is the sort of original cryptocurrency. It is a cryptocurrency that it is the same Bitcoin that existed before. What happened in 2017 was there was a big debate. People wanted to make the Bitcoin blockchain able to fit more transactions in it. So there was a group of people that changed the rules of the Bitcoin network and forked off. They created initially the Bitcoin ledger was moving linearly, and then some people wanted to change the rules and created a new version of Bitcoin with updated rules saying more transactions can fit in the Bitcoin blockchain. That became Bitcoin Cash. And everyone who had Bitcoin before that fork then had both Bitcoin and Bitcoin Cash. Now, Bitcoin Cash has since plummeted in value in comparison to Bitcoin. And this debate is a long debate. We can't really get into it today, but effectively the debate is, do we allow more transactions to fit in the Bitcoin blockchain? Or do we keep the Bitcoin blockchain small so that anybody, no matter how powerful their computer is, can participate in Bitcoin? And the argument that argument won out. That decentralization, keeping it as easy as possible to participate in Bitcoin is much more important than allowing more transactions to fit in Bitcoin. And so that's the difference between Bitcoin and Bitcoin Cash. Now, the difference between Bitcoin and Ethereum. So Bitcoin is sort of like digital gold. Ethereum and Bitcoin has really found its product market fit. Bitcoin does exactly what you think it's going to do. There's only ever going to be 21 million. People buy it because they think it's going to help preserve value long term, and historically that's what it's done. Ethereum is another cryptocurrency that was created. One of the criticisms of Ethereum was that 70% of that Ethereum was created and went to individuals who created it. But it's different than Bitcoin in the sense that it's more of a decentralized computer. It has computer programs running on the blockchain, and it's there's more sort of programmability built into Ethereum. It's easier to build your own kind of programs that run on this blockchain that can do their own sort of financial logic. And Ethereum is the root currency of this blockchain that is required to actually run these computations. And some people think that there'll be a big financial system kind of built within Ethereum, or maybe even a number of blockchains similar to Ethereum. And the investment sort of thesis from buying Ethereum is that this is kind of like the oil of this new computer decentralized this decentralized computer world. You need this oil to sort of run your program. But I would say this product market fit is less developed than Bitcoin. It kind of, the narrative around Ethereum changes every few years, but it's certainly interesting and worth paying attention to.
Great, thank you. Vince is asking, what are other types of cryptocurrencies besides Bitcoin?
So I think the last question sort of addressed that. There are always going to be a lot of different cryptocurrencies because the allure and the payoff of kind of creating your own currency out of thin air is going to be something that is irresistible. So you're always going to see lots of different cryptocurrencies. What I generally recommend, I personally only hold pretty much only Bitcoin. Every time there's a bubble, what we see is a lot of new cryptocurrencies coming along, or older, smaller ones getting really big all of a sudden, and inevitably they crash over the next year. But a lot of people get sucked up into trading those, think they're going to get rich. Some people do, just like some people win the lottery, but most people lose a lot of money. And so, every cryptocurrency has its own sort of pitch. I strongly suggest being very careful with buying anything other than Bitcoin. really understand what you're getting into. Be very careful before you start trading and trying to, thinking you're going to get rich quickly with this stuff. It's very, very risky, and most people lose their money. So another, like, I see more questions here similar to this, like, what are altcoins and why has Doge skyrocketed? This is just getting into, right now we're seeing a speculative mania, right? This happens every few years. I've been through a lot of these, so I don't pay as much attention anymore. But yes, the Dogecoin price has skyrocketed, and I just be very careful about sort of trying to FOMO into that. It probably won't end well.
Great. Let's see the next question. If a single Bitcoin is $50,000 or gets to $500,000, it's an unwieldy unit for currency. Is there a fractional unit emerging as a more practical use of Bitcoin, like 1 out of 1,000 or 1 out of 10,000?
Yes. So that unit I was talking about earlier, the Satoshi, is kind of getting more and more popular as a unit people track. As I mentioned, there's 100 million Satoshis in a Bitcoin, and so it's pretty easy to buy 1 million Satoshis, right? Normal things cost hundreds of thousands of Satoshis, which is more of a normal number for people. It's big, but as the Bitcoin price continues to go up, those numbers will actually become more and more normal. Eventually something that costs $1 might cost 100 Satoshis. And I think that'll be pretty natural for people.
Great, thank you. Nathaniel is asking, he owns a local business here called Blockchain Solutions Hawaii, and his focus is on building Bitcoin-based Lightning Network-enabled sidechains. And he views them as the website analog for the Bitcoin network. What are your thoughts on sidechains like Rootstock, Liquid, Makana versus building the same products on the base layer?
So Nathaniel's basically talking about how can we build an ecosystem of financial tools, ways to move money that connect to Bitcoin, but don't not everything goes onto the Bitcoin blockchain. We have called sidechains or layer 2. And I think there's a lot of interesting innovation to be done here. There's a lot of sort of decentralized financial tools that can be built through the Lightning Network or Liquid, or it sounds like Makana. That's very interesting. I'll look into that, and Rootstock as well. The answer is, I do think that there's going to be a lot of innovation here. I don't know exactly where the winners are going to be, but I think it's awesome that you're pursuing this. And I do think that the long-term kind of winners will be sort of largely off-chain compute and on-chain commitment. So yeah.
Great. Next one. I think you answered kind of a similar question to Tonia's question. So let's move on to the next one. If Bitcoin supply is limited and the demand is growing, why are there dips or crashes?
So when you say the Bitcoin supply is limited, I think it's important to understand what that really means. The amount of Bitcoin that exists is limited, but the amount of Bitcoin that exists isn't the same as the amount of Bitcoin somebody wants to sell. The amount of Bitcoin that somebody wants to sell changes day to day. Sometimes it's only miners who want to sell Bitcoin. Sometimes it's somebody who's had Bitcoin for a long time and decides they want to sell some, or they need to sell some. They want to buy a house. They want to do something else. There's a company that's had Bitcoin and they need to sell it to pay for something. So the supply of Bitcoin, the amount of Bitcoin that exists is very predictable, but the amount of Bitcoin that someone might want to sell at any given point in time is not predictable. And that's why prices change.
Awesome. And Brad has a question: with Bitcoin's low transaction speed, is it destined to become a reserve in an institutional store of value? Will it be adopted for everyday transactions?
Yeah, so kind of getting back to this idea of the layer 2, I think the Bitcoin blockchain will be a settlement layer, and it will continue to be slow because that is the only way that we can keep it very decentralized. I think the vast majority of day-to-day transactions, if Bitcoin ever does become a widespread medium of exchange, will be done on off-chain, on things called the Lightning Network, if you want a decentralized way to do that, or through centralized parties like financial institutions like ours. Not every dollar transaction needs to be posted to the blockchain, which is replicated on thousands of computers around the world. Kind of only the big important transactions need to go in there.
Okay, great. And the next question from Vince, will River Financial manage my Bitcoin portfolio similar to the way my stock portfolio manager does?
So we don't give financial advice. We will help you buy Bitcoin however much you want, but we won't make investment decisions for you. Now, most of our clients decide how much Bitcoin they want to buy. They buy it and they just let it sit there and keep an eye on it. That's what most of our clients do. We'll give our thoughts. We'll tell you what we're seeing from other people, but we won't ever tell you or actively make a trade for you without your consent.
Awesome. So we are actually coming up to the hour. I want to be respectful of Alexa's time as well as all the other attendees. I know we have a couple of questions here left, but I welcome all of you to email us at fintech.htdc.org, and we can definitely direct your questions back to Alex, for him to reply. But I wanted to thank you again, Alex, for your time today and for teaching us about Bitcoin.